Chapter 1, Where Most Investors Stumble. Speculators and Unsuccessful Investors. Investing versus Speculation. Mark Twain said that there are two times in a man's life when he should not speculate: when he can't afford it and when he can. Because this is so, understanding the difference between investment and speculation is the first step in achieving investment success. To investors, stocks represent fractional ownership of underlying business, and bonds are loans to those business. Investors make buy and sell decisions on the basis of the current price of securities compared with the perceived values of those securities. They transact when they think they know something that others don't care about, or prefer to ignore. They buy securities that appear to offer attractive returns for the risk incurred, and sell when the return no longer justifies the risk. Investors believe that over the long run, security prices tend to reflect fundamental developments involving the underlying business. Investors in a stock thus expect to profit in at least one or three possible ways: from free cash flow generated by the underlying business, which eventually will be reflected in a higher share price or distributed as dividends, from an increase in multiple that investors are willing to pay for the underlying business as reflected in a higher share price, or by a narrow of the gap between share price and underlying business
By
value.
narrowing the gap,
By a narrow
a narrowing of the gap.
between share price and underlying business value. Speculators, by contrast, buy and sell securities based on whether they have believed those securities will next rise or fall in price. Their judgment regarding future prices movement is based not on fundamentals, but on a prediction of the behavior of others. They regard securities as pieces of paper to be swapped back and forth, and are generally ignorant of or indifferent to investment fundamentals. They buy securities because they act well and sell when they don't. Indeed, even if it were certain that the world would end tomorrow, it is likely that some speculators would continue to trade securities based on what they thought the market would do today. Speculators are obsessed with guessing the direction of stock prices. Every morning on cable television, every afternoon on the stock market report, every weekend in Barron's, every week in dozens of markets newsletters. And whenever business people get together, there's rampant conjecture on where the market is heading. Many speculators attempt to predict the market direction by using technical analysis, past stock price fluctuation, as a guide. Technical analysis is based on the presumption that past share price meandering rather than underlying business value hold the key to future stock prices. In reality, no one knows that the market will do. Trying to predict it is a waste of time, and investing based upon that prediction is a speculating undertaking. Market participants do not wear badges that identify them as investors or speculators. It is sometimes difficult to tell the two apart without studying their behavior in length. Examining what they own is not a giveaway. For any security that can be owned by investors, speculators, or both. Indeed, many investment professionals actually perform as speculators much of the time because of the way they define their mission: pursuing short-term trading profits from predictions of market fluctuation rather than long-term investment profits based on business fundamentals. As we shall see, investors have a reasonable chance of achieving long-term investment success. Speculators, by contrast, are likely to lose money over time. Trading sardines and eating sardines. The essence of speculation. There is the old story about market craze in sardine trading, when the sardines disappear from their traditional waters in Monterey, California. The commodity traders bid them up, and the price of the can of sardines soared. One day, a buyer decided to treat himself to an expensive meal and actually opened a can and started eating. He immediately became ill and told the seller the sardines were no good. The seller said, "You don't understand. These are not eating sardines. They are trading sardines." Like sardine traders, many financial market participants are attracted to speculation, never bother to taste the sardines they are trading. Speculation offers the prospect of instant gratification, which why get rich slowly if you can get rich quickly? Moreover, speculation involves going along with the crowd, not against it. There is comfort in consensus. Those in the majority gain confidence from their very number. Today, many financial market participants, knowingly or unknowingly, have become speculators. They may not even realize that they are playing a greater fool game, buying overvalued securities and hoping to find someone a greater fool to buy from them at a still higher price. There is great allure to treating stocks as pieces of paper that trade. Viewing stocks this way requires neither rigorous analysis nor knowledge of the underlying business. Moreover, trading in and itself can be exciting. Of itself can be exciting, and as long as the market rising, lucrative.
Market is rising,
lucrative. But essentially, it is speculating, not investing. You may find a buyer at a high price, a greater fool, or you may not, in which case you yourself are the greater fool. Value investors pay attention to financial reality in making their investment decisions. Speculators have no such tether. Since many of today's market's participants are speculators and not investors, business fundamentals are not necessarily limiting factor in securities pricing. The result, propensity of the stock market to periodically become and remain overvalued, is all the more reason for fundamental investors to be careful, avoiding any overpriced investments that will require selling to another, even greater fool. Speculative activity can erupt on Wall Street at any time and is not usually recognized as such. Considerable time has passed and much money has been lost. In the middle of 1983, to cite one example, the capital markets assigned a combined market value over $5 billion to 12 publicly traded venture capital backed Winchester disk drive manufacturers. Between 1977 and 1884, 43 different manufacturers of Winchester disk drives received venture capital financing. A Harvard Business School study entitled Capital Market Myopia 2 calculated that industry fundamentals as of 1983 cannot then nor in the foreseeable future have justified the total market capitalization of these companies. The study determined that a few firms might ultimately succeed and dominate the industry, while many of the others would struggle or fail. The high potential returns from the winners, if any emerge, would not offset the losses from the others. While investors at the same time may not have realized the shares of these disk drive companies were essentially trading sardines. This speculative bubble burst soon thereafter, with the total market capitalization of these companies declining from $5.4 billion in mid-1983 to $1.5 billion at year-end 1984. Another example of such speculative activity took place in September 1989. The shares of Spain Fund Incorporated, a closed-end mutual fund investing in publicly traded Spanish securities, were bid up in a price from approximately net value asset, or NAV, the combined market value of the underlying investments divided by the number of shares outstanding, to more than twice that level. Much of the buying emanated from Japan, where underlying value was evidently less important to investors than other considerations. Although an identical portfolio to that owned by the Spain Fund could have been freely purchased on the Spanish stock market for half the price of Spain Fund shares, these Japanese speculators were not deterred. The Spain Fund price at twice net asset value was another example of trading sardines. The only possible reason for buying the Spain Fund rather than the underlying securities was the belief that its shares would appreciate to an even more overpriced level. Within months of the speculative advance, the share price plunged back to pre-rally levels, once again approximating the NAV, which itself had never significantly fluctuated. For still another example of speculation on Wall Street, consider the U.S. government bond market, in which traders buy and sell billions of dollars worth of 30-year U.S. Treasury bonds every day. Even long-term investors seldom hold 30-year government bonds to maturity. According to Albert Wajnalower, the average holding period of U.S. Treasury bonds with maturities of 10 years or more is only 20 days. Professional traders and so-called investors alike price 30-year Treasury bonds for their liquidity and use them to speculate on short-term interest rates movements, while never contemplating the prospect of actually holding them to maturity. Yet someone who buys long-term securities intending to quickly resell rather than hold is a speculator, and 30-year Treasury bonds have also effectively become trading sardines. We can all wonder what would happen if the 30-year Treasury bond fell from favor as a speculative vehicle, causing these short-term holders to rush to sell at once and turning 30-year Treasury bonds back to eating sardines.